Hello ladies and gentlemen, and welcome back. Well, we have a massive show here today because not only are we seeing island reversals similar to the June lows that began a massive squeeze, but on top of that we have similar thrust, breadth, and something that we've only seen 6 times in over 20 years. Yep, 100% bid rate. We'll be talking about that and more in today's video, but you've got to open your mind to the idea that rallies could push into extremes before potential drops later on. Yeah, this market's sneaky right now in 2022, so let's begin by discussing and navigating it right now. Well, welcome back everybody to the Daily Show where we talk about stocks, commodities, and cryptos. As per usual, we'll go through the headlines, the macro data, and then we'll jump into the lead indicators that you should be watching and the key levels. OPEC Plus, they're at it again. They're cutting barrels and increasing the cost of oil. Just what, of course, everybody ordered in this world, more expensive oil. Yep, the cartel is doing it, and it's moved through the level of supply to the next zone. So we're sitting on almost $90 a barrel at this stage. Yeah, it's very manipulated, so you've always got to be careful when you're talking about oil, and you can just see the impact that OPEC Plus has on these massive moves in these markets. So let's talk about the crazy stat. Since 1996, we've only ever seen 6 instances of 100% bid. Now, a lot of you have been asking, what the hell is 100% bid? It means that every single stock in the Nasdaq was up over that day. That's very rare. All 100 were up. Now, we've only seen 6 other times that's happened. And more importantly, if you notice here, it generally has been always with further rallies to come in markets. You've got to be very, very careful about this. It's never happened. I repeat, it's never happened in this recorded history that we have during a bear market rally. So does this mean that we're about to see the turnaround in this market and that actually everyone's getting trapped in these lows? Well, bulls certainly could make a case for that. Of course, a lot of you are probably disagreeing with me right now, but hear me out as we go through some of these stats. 2 days of exceptional positive breadth. Now, straight away, you're going to say, yeah, breadth doesn't matter. It's failed this year before. It does, and it has failed. It has been also one of the most historically best indicators for picking bottoms in the market. So we've seen New York Stock Exchange up issues versus down issues over 5-1. We've also seen the volume come along with that. Up volume versus down volume has increased significantly. And when we start to stack these together, where we have back-to-back days with 5-1 New York Stock Exchange up issues versus down, we come into a fairly important, fairly illustrious kind of history of these types of days. Now, when we've seen these thrusts, here's the important part. Over the next week, we've sometimes seen weakness. But after that, look at the stats as we go out 3 months, 6 months, and 12 months. 100% of the time when we've had this reading, 12 months later, we've been bullish. Most of the time, a few months later, we've been bullish. And it's not just a little bit of percentage, it's considerable, 21.6% on average over that next 12 months. So we have seen this a few times in 2022. But where it does start to get a little bit more different is when we look at volume thrusts as well. Now, we've had a reading similar to this, not exactly this one, but similar to this in 2022. And when we have SP500 after back-to-back days with up issues and volume thrusts, we get into even less chances of this occurring and even more statistical chances of bullish case scenarios. And again, not just a little bit, very significant. Does that mean that you go out and you say, oh, I think the market's over and it's all going bullish? No, but it is certainly a very strong statistic. And let's just bring up some other things that further strengthen this bull case. And it's kind of like we've been talking about this turning point here for a little while. Smart money versus dumb money. We've seen this play out a few times where we've had huge changes from smart money to dumb money, and it's marked bottoms in the market. It's marked bottoms in the market. These big discrepancies between smart money and dumb money indicators, and that's basically shown us that everyone was a little bit too negative on the markets. When we saw these types of readings and we saw such a huge spread, you can see here that a few weeks later, we also had some very positive statistics in these markets. And while the macro data and the statistics around that over the next 2 to 3 months definitely push to the lower side, you'll notice that all of this is talking about the next 1 to 3 months predominantly. Yeah, some of them show 12, but 1 to 3 months, very bullish statistics there. Options traders are spending huge amounts on protection. Nothing new. 3rd week expiration coming up in October. That's going to be a big one. And we've got thrusts here across the board. On top of that, we've also got so much put protection. Retail put options premium as a percentage of the US stock market capitalization hit 4.5% in September 23rd. It would have been higher after that. Now, these often coincided with little pickups in the markets. And of course, it's also strengthened our case here to be saying that the markets were turning bullish. Now, for longer term investors, they'll come in and they'll say, well, that's cool and all. Why should I even be positive or bullish on this market? Well, often playing the stats here is also another big game. And forward PE, although a lot of you out there will say, well, I don't like using forward PE, fair enough, is starting to get down into the less than the average level. We're underneath the 25-year average, and we're starting to move to the 1 standard deviation away. As of September 30th, we were trading at 15.15. So we were trading underneath the 25-year average. Well, averages aren't necessarily the worst thing ever when it comes to market levels. 2-year yields often also peak around 1 to 1.5 months before the end of the Fed cycle hiking. We don't even know where that's going to be. It keeps moving and shifting. What we do know, though, at this stage is instead of being up to 4.5% and then flatlining till December of 2023, we've now got kind of a market that goes up to 4.5%, maybe 4.3%, and gets cut much earlier. That's a lot more positive than the market was being on yield. So have we seen the peak? Maybe not yet, but certainly something to keep in the mind. Keep that stat in there, 1 to 1.5 months before. So why can you even make a bullish case? Well, you've got the thrust, you've got the breadth, you've got the crazy stat of the first time in a long time that we've seen, of course, 100% bid rate. Obviously, the algorithms, the squeeze control, they're feeling very bullish about this market. But should we like it from seasonality? Well, the answer is yes. Midterm years historically bottom on September 30th before an end of year rally. Seem familiar? It's pretty much where we are right now at the time of this recording. We've seen that turnaround, and we've been following this kind of concept all year. We've realistically really slammed it out, of course, in August and September, and it's following that idea. If you take just years that end in a 2, so 2002, 2000, blah, 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 anything that ends in a 2, basically we have here realistically the October 5th before end rally being even stronger. So this has been a very, very strong period. Again, it just shows that historical movement of the markets. Now you'll notice that, of course, that wasn't how it worked. We had August, the middle of August, and actually sold off. But still, important to note, October, midterms, 2s, these types of things do load it through. Here's, of course, all of the midterm election years versus the standard years. Most people believe sell off into the back of October with, of course, a rally, but midterms tend to go a little bit earlier. They go before the midterm itself. Here's the average of all of the bear markets over time. That's over 200 years of data if you wish to pause it there. And let's look at our scenarios here. So, of course, we're most heavily correlated with 2008 right now. A rally being met by a watershed moment. It's still possible. It's scary. And of course, that's what people are trying to protect themselves from. But if we go over here to 2015, obviously we're well further down percentage-wise than this. We actually saw a very similar turnaround. Markets can often do this. They kind of make a low, breach it, and then go off on a rally. They make a low and they breach it and they go off on a rally. We have to be open and flexible to the idea that at least there could be a rally here for now that squeezes people out and then possibly turns into a short later on. Let's move over to this particular one. The SP 500 stocks above the 200-day moving average. We hit those lows. It created a bull case style scenario. We're now bouncing a little bit. Now we could bounce a little bit more and then move back down. Don't worry, bears. There's still plenty of levels for you moving forward. It just may not be right here, right now. The VIX dropping significantly. We've hit this level a lot of times. Every time we've kind of manifested ourselves into that 34, 35, we tend to be finding lows and then bouncing back over those. Do we go back down all the way into like a 20 to a 23 VIX? And these levels can help us figure out maybe a key resistance or a key supply zone on the markets. Maybe we are moving into a bit of strength for seasonality followed by some epic shorting later on and some capitalization. That could be certainly a case. 2-year yields, you'll want to be watching this. If we continue to climb on the S&P 500 and yields keep going up, we've seen that story play out before. What eventually happens is the S&P 500 will tip and yields, of course, will hopefully hold that level. Remember, there has been a correlation with the 2-year. If you notice here, 2-year is increasing, stock market is decreasing. Definitely worthwhile having on your charts, and all yields are worthwhile watching. At this stage, we're seeing yields drop a little bit, but of course, that may change. What about bonds? Well, we saw a bid for high yield corp bonds. And I think this is just the market basically saying to all of us out there, hey guys, the central banks are out here and we're potentially going to have to protect parts of the economy. And I think the market's moving to, oh, well, we know the central banks are going to come back in. The Bank of England broke the system the other day. They basically proved to the market that they will come in to support catastrophic events. This sucks for bears. It kind of sucks for bulls too in some ways, because what it means is they're off-putting the issue to later on. If we get through this, it eventually will become an epic shit show. Yeah, it really will. It'll become epic and it will be terrible. And of course, everything will collapse. And we'll talk about that should we get through this one. But high yields are up, as well as we saw a slight increase in corps. And I can tell you my lead bond indicators found another bullish day out of yesterday. So they found a bearish the day before, which pushed us hopefully towards the downside. But after the previous session, we saw bullish again. So the bonds are kind of coming up and saying, well, maybe we're finding a little bit of respite. We're prepared to bid on the market right now. TLT sitting still in the very strong demand zone. We've mentioned that before. We'll just leave that chart there. But I want to go over to the dollar index because it did exactly what we talked about. It found a bid, it found buyers, demand came in at that 110.25 zone, and we bounced all the way back into a very critical zone. This zone here that basically acts as previous supply. This was where we saw that break of structure towards the downside. So if the dollar continues to weaken here and it can't make a new high, that's going to be, of course, strong for the stock market and weak for the dollar. That's what you're looking for. You want to see the dollar go underneath this zone again and go specifically through about that 109.50. And if that happens, you can load up a weekly and go towards the bigger mean reversion. Go towards the weekly 20. And at this zone, ideally, we'd be synergizing with a key resistance or a key supply on the stock market. Imagine if we were here and we were at, let's say, something like 41.50 or something like that, or at 4,000 or something like that. These levels would be amazing to hit with synergy of the dollar index. You have to keep your mind open to a squeeze here coming in these markets. There's so many shorters, the markets seem to be allocating to that. The cartel pushed it through, so oil obviously made that big break here. Still looking for 90 a barrel on oil. We'll see whether it can get it done. It broke through that supply, and yep, the news got you on this one if you were short. Unfortunate, but that's the way it goes sometimes in news. What about gold? Well, gold found a level. It shorted off, like we discussed, and it came down to the key first target zone. I have a little alert sitting underneath here just in case it had broken through to further lows, looking towards this next level. But with gold, you've got to be open now to it breaching this zone and moving towards the next area. Where's the next area? Sitting around that 1762, 1760 zone. So something in there would be, if you're feeling bullish on gold, if it breaks through, that would be the next level to look towards. And gold's having a nice turnaround here. Now, gold will only bounce heavily if we see yields continue to drop. If yields start to spike, expect gold to decline. Gold hates increasing yields. So it's like the recent news, but nothing else. Silver traders, nothing yet, guys. We have to get through here to prove that we're finding really strong buyers and then that we look towards those pickups and, of course, longer term silver turnarounds. It's a great base. It's certainly broken to the high, but yeah, that's all we've got right there. Tesla came under more fire. Of course, Elon is, I don't know what's going on with Twitter actually, but Elon and Twitter and all sorts of things, that's hurting sentiment on the stock itself. And it looks like it's still moving down towards that 220 level. Unfortunately, there's a decent amount of sellers here in Tesla, but if the stock market continues to find bulls, effectively you'll see bounces here. Look for a break of the previous high to show you that there's further bull momentum, maybe pushing us back into 265. But if stocks fail, expect Tesla to easily make it to 220. That's of course the A distance, which is the distance of the double top, equaling the B distance, which pushes us to 220. So this is not the stock of choice right now in the markets towards the bull side. Apple did pretty well. We found another decent day of bid, ended up 0.21%. It did drop in the morning and it got back to the wicks, and we saw that kind of close there, but nothing much to report here on Apple. It's neither at a 20 moving average, which has found previous resistance. It's in the middle of literally nowhere. It did kind of fill that wick to wick gap though. Let's move over to some other markets. Semiconductors. Now this is the first case we see an island. We've got a market that has gone bullish, as in like it's gone bearish, sorry. It's made some nice structure and then it's gone bullish. Now we saw a similar situation back over here in July. And this is what we call an island reversal. Effectively the market's come down, it's gapped, it's structured up and formed some form of accumulation base, and then it's gapped to the bull side. Now we've seen a day where it wasn't even able to get down. It found demand, it found bid, it found buyers really fast. So that's pushing towards the bullish idea here. And semiconductors are often a lead here in markets. So that's what we've seen. Let's move over to the indices. We've had big, strong bid come out for the FTSE. It's held this level, the most important zone for it. We've got alerts underneath just in case. And it's really done well because of OPEC as well. A lot of energy stocks in the UK, and they're all firing off that level. The same goes for the DAX. Of course, a few big kind of older school kind of businesses here with the reassurance in the financial system. Although it's counter logic, we've seen those kind of pickups. Could we be returning back to our beautiful trend line here for the DAX? It seems potentially likely, and let's now have a look at it based on the markets. First up, SP500. Let's have a look at the SPX here. Notice a very similar island reversal. Now we spoke about this, we called this one out previously back in June and July, and we talked about the idea that it would bounce, move down, and then ideally find bid. Now we're looking at a similar scenario. We've got here a big island. We've got a sell-off that did occur in the previous session, but it found buyers really quick. I would have liked to see it come down more, but because it didn't, it proves this island kind of concept. And we've got to be open to the idea that this market could squeeze some serious levels. Now, where are those serious levels sitting? Well, the first up one is sitting, of course, around that 39.20, which is in here. And you've got to be open to that one. The second squeeze, a really extreme squeeze, would be pushing that 4100 narrative. And if we get the market into here, the more it squeezes, the more you want to place a big short on it back down in. But if it does squeeze heavily, especially if the thrusts continue, the way that this market's picking up continues, you have to be open that if we get that pullback later on, which I suspect we will, that all of a sudden this bull case becomes more likely, more possible. So don't worry, bears, don't fret. I believe there's levels for you still. But based on the last 24 hours, there's a really good chance that buyers will commit to this. We saw them commit in the previous session. We saw them, of course, commit previously back over here on the left-hand side. And let's have a look now at the futures market. So you can see there's a decent amount of confluence around these levels up here. We've got that previous structure. We know 39, 39.20 held quite a lot of orders in the past, so it's probably going to again. We see the pullback that happened in the last session and then a strong bid that came straight through. Ideally, well, for a lot of us, we would have hoped it would come down to a 36.80 and then find the bid. It wasn't to be. It just went bang up. Now, if you're a bear and you're thinking, well, I hope this turns around now, until you get underneath that 37.20, you can't really short it easily. You either need it at a more extreme level, you're either going to have a tight stop loss, or you're waiting for it to get underneath here and then waiting for that kind of structural move down. If you get this, okay, cool, things change. But at this stage, at the time of recording, we're looking for a new high and a new high to probably push the narrative up to that 39.20. You've got to be very careful here. Now, some people have said, well, this is the last resistance. Absolutely, it's possible that it does find it here. You could try to short it if you wish to, but the breadth, the thrust, the bid rate, all of these things are going against you from that under the hood kind of market stuff. The US 100 is similar. It's kind of front loading here. You can see again, there's some level that could be a bit of a concern, but once you clear this, boom, up till this level seems very, very likely. That's a 12,000 on the Nasdaq. And to weaken here, you would need to go underneath here, pull back, and then look towards shorts. That would be the strategy that would be probably the best one here on these Nasdaqs. Of course, it's just hypotheticals, guys. Practice your own risk management, etc. And don't, take anything in particular from these things. You know what I mean? It's general educational stuff. Let's look at Bitcoin. What do we got going on here? Well, Bitcoin is interesting. It's closed at a high. It didn't wick like the previous supply. And if this stock market goes up, Bitcoin should come with it. And where's the next levels for Bitcoin? Well, this is the problem. They all synergize together. You're looking at like a 22,500 for Bitcoin. Big volume transactions here. A few people have sent me messages saying that some big wallets have gone back and they've gone off the exchange and they've gone back into storage. So is that showing you bullish momentum here on Bitcoin? Certainly something that's open here, I think, in the charts. If you haven't already, come and follow us over at FX Evolution. You'll see we share a bunch of things on Twitter. So definitely follow us over there. And of course, for the news for the week ahead, this is probably what's going to move these markets. We have some big data coming out, and that all happens on Friday. The non-farm payrolls, the jobs numbers for the US. And don't forget that next week, when we go down here and we look into the week after this one, we have PPI coming out 8:30 a.m. on the Wednesday, October, the FOMC meeting minutes, and the most important one here at the moment, the CPI numbers. So they all come out next week. So we're probably going to push to some form of extreme ahead of these numbers. Will that be a 3,920? Will that be back down into the lows? We don't exactly know, but from thrust, from breadth, from bid, it looks towards the bullish side over the next couple of days. Although that may be counter logic to how many of us think out there, the macro data looks tough, everything looks bad. There's so many bears in this market, and clearly based on the under the hood, we're seeing those thrusts. Good luck today, guys. Make sure you, of course, always practice risk management in the markets. And if you're interested in finding out more about some of the courses we offer, you can do so over at www.fxevolution.com, or the links in the description down below. Subscribe, smash the like button. We'll see you in the next one. Bye for now.